Imagine you wake up tomorrow and your phone buzzes non-stop. Bank alerts, news flashes, markets frozen. The dollar didn't crash in flames, it just stopped being trusted. No explosions, no sirens, just a quiet panic spreading faster than any headline. This isn't a fantasy scenario. It's a thought experiment economists, governments, and hedge funds run all the time. Because the dollar isn't just America's money, it's the backbone of the modern world. So what actually happens if that backbone starts to crack? Not in theory, but day by day. Let's start with why this even matters right now. For decades, the US dollar has been the default language of global trade. Oil is priced in dollars. Debt is written in dollars. Central banks hoard dollars like survival rations, not because it's perfect, but because it's been the least bad option. That trust was built on three things: a massive economy, deep financial markets, and the belief that the U.S. would always pay its debts. Belief is doing a lot of work there. Now imagine that belief takes a hit, not from one dramatic event, but from a slow pile-up. Rising debt, political gridlock, money printing that feels endless, foreign governments quietly reducing dollar reserves. Nothing breaks overnight, until one day something does. Day 1. Markets open nervous. Bond yields jump. That's the first crack most people miss. When investors demand higher yields, they're saying one thing: I trust you less. The U.S. government suddenly has to pay more just to borrow. Trillions in debt become more expensive overnight. Not future debt, existing debt rolling over. The dollar dips, not collapses, just enough to make traders lean forward. Day 2. Corporations feel it next. Companies that rely on imports watch costs jump. Energy, electronics, raw materials. Prices don't explode yet, but finance departments panic quietly. Hedging costs spike. Credit lines tighten. Banks become cautious, very cautious. They don't stop lending, they slow it down. That's how financial stress really starts, not with a shutdown, with hesitation. Day 3. Foreign governments start making calls. Central banks in Asia and the Middle East ask a dangerous question. Do we really need this many dollars? They don't dump everything. That would hurt them too. Instead, they rebalance. A little less dollar, a little more gold, a little more euro, a little more yuan. Each move is rational.
Together, they send a message. The dollar isn't sacred anymore. Day 4. This is when regular people notice. Gas prices tick up. Food prices creep higher. Anything imported quietly costs more. News anchors say it's temporary volatility. They always do. But households feel the squeeze. Paychecks don't adjust daily. Prices do. Confidence slips, and confidence is the real currency. Day 5. The stock market swings wildly, not because companies vanished, but because the math changed. Higher interest rates mean lower valuations. Future profits are worth less today. That's boring math, and devastating math. Retirement accounts wobble. Pensions feel pressure. Nobody panics yet, but everyone is watching. Day 6. This is where irony kicks in. As trust in the dollar falls globally, demand spikes locally. People want cash, real cash. Banks see withdrawals increase. Not a run, a shuffle. The Federal Reserve steps in, calm voice, emergency tools, liquidity injections. The same tools that caused the problem now promise to fix it. That contradiction doesn't go unnoticed. Day 7. Other countries adjust faster than expected. Trade deals start shifting currencies. Oil contracts experiment with non-dollar pricing. Nothing dramatic, just options. The dollar doesn't disappear, it loses exclusivity, and exclusivity was the superpower. Week 2. Inflation becomes undeniable. Not hyperinflation, that's a different movie. This is slow, grinding erosion. Savings lose purchasing power, wages lag, debt feels heavier for households, lighter for governments. That's not an accident. Week 3. The uncomfortable math emerges. America's debt only works because it's cheap to service. If rates stay high, the numbers stop behaving. More tax revenue goes to interest, less to everything else. Defense, healthcare, infrastructure. Choices get political. Fast. Week 4. Global markets adapt. The world doesn't end, it reroutes. New financial plumbing forms. Messier, slower, less efficient. Trade becomes more regional. Risk becomes more expensive. Growth slows. And that's the real cost. Not collapse, but drag. Here's the part nobody likes to say out loud. A dollar collapse wouldn't look like a sudden death. It would look like a long downgrade. From unquestioned default to one option among many. The hype says chaos. The reality says adjustment. Painful, uneven, political. The dollar wouldn't disappear. It would age. And aging empires don't fall in a day. They adapt badly, or slowly, or too late. The world has rehearsed this quietly. The question isn't if alternatives exist, it's how fast trust moves when it finally decides to move. So here's the uncomfortable question to sit with. If the dollar's power is built on belief, what happens the day belief becomes optional?